Good morning, ladies and gentlemen. This is Clueless 8, and this is the pre-market AM report for Friday monthly quadruple options expiration, what's also known as quad witching hour. Couple of very critical observations. We're in the midst of a major mini market turmoil in the sense of volatility, in the sense of couple of global macro factors that's directly correlated with the Fed raising rates for the first time in 9 years. We have currency movements. We have commodities dropping sharply, namely oil and coal, causing ripple effects across the high yield bond market. And from a report released early this morning, said that a significant number of smaller hedge funds which dealt in that arena are basically shutting down. And when I mean in the arena, in the high yield bond arena, especially in the lower rated paper, also known as junk bonds, simply means high yielding bonds and lower rated bonds, they're shutting their doors and returning money as much as they can to their investors. When you have these type of perfect storm, you tend to see the after effects of that on the surface, which is basically the equity markets. Overall, on a fundamental basis, there's really nothing wrong with equity markets, in my opinion. However, we do not live in a vacuum. We live in a world where everything is interconnected, with different asset classes having outsized effects on another asset class. Saying all that, the turmoil and the manipulation by algorithmic high frequency trading programs in the marketplace, which dominate about 90+% of the trading on a daily basis, makes life extremely unpredictable and difficult. There's an old saying, and my dad used to remind me of that. If you think life is hard, then everything you do is easy. I don't want to make light of that, but I believe that trading, just like life, and as you very well know, I draw the comparison all the time, is not a cakewalk. It's not a walk in the park. We have done extremely well throughout this whole period, going back since the beginning of my service on April 15th of 2014, and despite every single market turmoil, we have overall tended to have pretty outsized gains. Selectivity is the key. Complacency and sitting back and just thinking that everything is going to be a linear process. In other words, if I buy it here, it's definitively going to get there within your own time frame, is a fundamental error. That's something I can't teach. It's something you'll have to basically learn to deal with. Now, saying all that, traders who are not active, who do not constantly monitor the charts, traders who don't understand how the futures markets work, and that's what's behind you, and I'm going to go over that in a few minutes, obviously get caught in these swirls all the time. Now, there are days that you can have, it doesn't mean that every day that you're trading or every day that you're looking at your P&L is going to be a green day. But when you get outsized moves like you did from the Fed, for example, and even prior to the Fed, which was on at 3 o'clock on Tuesday, and then again at 3 o'clock at 2 o'clock on Wednesday, this particular candle, for example, was worth a significant amount of money. If you go through my Twitter alerts and my trade posts, and I'm only here to be a faster messenger of the markets, I'm here to try to help people as much as possible within reason, then you know very well that I had put out some very important alerts telling people to take a substantial amount of their profits off the table. And that's the only way to do it. This is not an easy game, but there's a lot of money being made. And I love what I do because I don't have a choice. Okay? A lot of people have choices. They think, well, if I'm not going to trade, it's fine. I've some other job. To me, this is what I do for a living. And good, bad, or ugly markets, I tend to come out pretty okay. Saying all that, I wish you all well, and let's get straight into the technicals. At this point in time, we have quad witching. This is going to be one of the most fiercest volatile days in the market. The weaker the market opens, in my opinion, the better off it is. I put out an article out there this morning which talks about the notional value of somewhere like $600+ billion worth of options that need to be expired at around S&P 2045. Yesterday we closed at 2042. Okay? So the bottom line is the lower you go from that level, then traders, and these are active traders, futures traders, are forced to sell positions, and stops are triggered, and the lower we go. So let me show you a couple of levels here that I think work out good. Now, in the meantime, what happens today has absolutely no bearing what's going to happen next week. Just letting you know, because the intense volatility that's generated because of all these macro global factors that I spoke about, which generates multi-million dollar large, who knows, maybe $1 billion worth of $1 billion+ worth of institutional forced margin sellouts, cause everything around it to get hit. And that's known as friendly fire. It's like the old saying, throwing the baby out with the bathwater. Well, a lot of babies are getting thrown out with the bathwater. And despite all that, you still have powerful winners every single day. The latest one being Red Hat, that's up more than 6% in the midst of this market pullback. So on a technical basis, I have, let me go through this here. This level here on the E-minis, and everyone has their trading platform. They have to look at these futures charts because this is what the backstage, this is what's happening in behind the scenes. So if you can understand the futures chart, you don't need to panic and you can act accordingly. So this line here, which is the 2010 level, 2009.96 or 69, whatever the case may be, right there. This is a auto arrow generated by Thinkorswim based on the stochastics and the MACDs and all that stuff. This is not my arrow that I drew, but this level is key, the 2010 level. Below the 2010 level, you can see the confluence of the Bollingers and the acceleration bands at around 2005. You can see that. We break that, we're going to fall very quickly into the 1980 range. Okay? This pattern here, which I'm going to draw out for you, is a descending channel, right? Or you can call it a descending right there. So I'm not matching all the numbers properly, but just to give you an idea. This obviously means this is a negative pattern. So any break below this 2008 level causes a sharp fall, a sharp pullback. At this point, we're starting to bounce a little bit. So a breakout over 2024 would bring us to engage this very powerful, and I'm just making this line a little bit thicker so people can see it. This is one of the downtrend lines from the highs of 2090, and this is the major downtrend line from the highs of 2105 on the E-minis. So this downtrend line, as you can clearly see, acted as a major support till about 11 a.m. yesterday. Sharp bounce, went and engaged the 50 SMA, failed, and went straight down. This methodical robotic selling that started at 2 p.m. yesterday was generated by a large amount of forced selling on the commodity space by a significant, by a small group of hedge funds which had to liquidate. So 1, 2, 3. Okay. This is the overnight action. Okay, the overnight action, we went lower and now we're starting to turn. Now, any break above 2024 will engage and retest the backside on the underbelly of the, and which acts as a major downtrend resistance, is the downtrend line is 2032. Over 2032, it is possible to engage the upper Bollinger and the 50 SMA here at 2043. This pattern symmetry, as hard as it might be to believe, let me get my drawing tool out here. Okay, this pattern symmetry that we're seeing is very, very possible. This is a major resistance. I'm not sure if it's possible today. I'm just saying it's possible over the next 24 to 48 hours. So the bull case scenario, to play the game on the long side, and you have to be very tactical. You can't, honestly speaking, you can't just walk away, come back a couple of hours later and wonder, oh, whoa, 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 what happened? Because this is a mechanical market and the machines are moving furiously. I want to remind everyone, if you're doing intraday trades, what you're basically doing is you're trading against supercomputers. Okay? And that's the reason why my algo HFT charts, which this one is think or swim, but the algo HFT charts are so critical in my determination of what is happening. I did put the UVXY hedge out there in place, and as you can clearly see, that's up more than $5 from the point of entry. So hedges are extremely important too. But then at the same time, if you hedge too big and the market does turn, you get blasted out. It's happened to me, and I'm sure it's happened to a lot of you many times. So this pattern symmetry of going back and retesting the 2070 level is not a distinct possibility. It's a mechanical possibility. All right? Now, in the short term today, this should act as major, major resistance, the 2030 level. I'll be posting charts throughout the day. However, I don't want to inundate people with too many charts because I realize, and sometimes it's frustrating on my part, that people are not really studying them. And if they don't study them, they are just shocked. They just, like they say, you gotta have the tools in hand. You gotta adapt. And if you don't, if you think that you're just gonna, walk in and just walk out with large profits under your belt, it ain't gonna happen. The hardest profits are made when we are playing on the buying some serious technical lows or shorting technical highs. So now on the bearish side, if we break through this 2010 level, then at that point we're going to fall rather rapidly. Is it possible to fall 30 points on the S&P, which comes to about 200 plus points again? Absolutely. I believe the 1980 level is a major support level, and this entire pattern symmetry, again, gets to be a large dragon bullish, or at least a dead cat bounce up towards these levels that I just showed you. Okay, you can look at it like that. In between, as you can tell, there are significant amounts of mini dragon bullish patterns that I've played successfully in many cases, and those are the ones that are constantly replicating themselves within the framework of different time frames, this being a 1 hour chart. Okay, this was the Fed spike that took a lot of shorts by surprise. So what they basically did, they came back here, they got their monies back. Okay, remember, if you're short here, you're break even here, right? And then they bumped it up, and then came that big selling. I feel that a good amount of these hedge funds, which are being forcefully liquidated, are using the currency of higher prices in order to meet their margin calls. Very simple to understand. This is where we are right now, and again, don't chase things. Just because you think something's moving and you run into and buy it, you know what? A lot of the times it doesn't work that way. You get hit right away. So you got to buy technical lows, and I'll guide as much as possible, but it's not possible in a fast market. Just warning everyone, for me to keep on posting every 5 minutes. Unless you track your own charts, unless you have some serious tools like the Algo HFT charts from the bar charts from Quad, with many of you are doing some free trials. Some of you have subscribed already. I'll be giving a free session on that this weekend on my own time, because I want people to help themselves do what they need to do. So that's it. It's going to be one heck of a day, and I intend to come out green. Thank you for listening.